back to this week's market update. Today is March 23rd, 2026, and we'll jump right in. Markets finished in the red for another week as the conflict with Iran continued to weigh on market sentiment. As of Friday's close, the S&P 500 fell 1.9%, the Nasdaq Composite down 2.07%, and the Dow down 2.11%. However, much of these losses have been reversed this morning, with Trump saying that the US and Iran have had productive talks over the weekend. So you can see Dow up 2.3, as well as the Nasdaq, S&P 500 not far behind, and then small caps up a whopping 3.5% this Monday morning. Shifting gears into last week's economic news, though, last week the Federal Open Market Committee voted 11-1 to hold the federal funds rate steady at a range of 3.5 to 3.75%, extending the pause in this latest easing cycle. At the press conference, Chair Powell acknowledged that while the Fed still expects progress on inflation, it may take longer than previously thought, likely related to the jump in energy prices stemming from the conflict in the Middle East. The overall tone continued to be a wait-and-see environment as the central bank navigates the dueling fears of a slowing labor market and potential for higher inflation due to higher energy prices. Although this was before the updates as of this Monday morning, so we'll have to wait and see how the Fed recalibrates as a result of a potential resolution in the Iran conflict. Diving a little bit deeper into the Federal Reserve meeting, though, we did get a quarterly summary of economic projections, which includes the updated dot plot. Looking at how the dot plot changed from the last one in December of 2025 to now, we can see the expectations for interest rates in 2026 were quite dispersed. Just 3 months ago, now you can see for 2026, we have a lot more agreement between interest rates. So right here, you can see 7 voting members suggested that they may want to keep rates the same through all of this year. Another 7 voting for one small 25 basis point rate cut, and then 5 other members voting for various amounts of rate cuts, as much as a whole percent of cuts this year. Overall, though, it does look like we'll land in the 0 to 1 rate cut, at least based on the data for now. However, if the conflict in the Middle East continues to resolve, inflation is not as much of a concern, we could see this continue to shift lower as the Fed focuses more on the slowing employment data rather than inflationary risks. Also, in the summary of economic projections, we had real GDP expectations be revised up for the coming 3 years, so that's a positive sign there. The unemployment rate fairly consistent from last quarter's projections, although we did get a slight upward revision for 2027. Inflation expectations did move somewhat higher for the near term, being revised up from 2.4 to 2.7% for this year. Core PCE also being revised up a bit there. And then last but not least, from a different perspective, the median expectation for the federal funds rate, the thing that the Fed can actually control, that stayed consistent for the coming 3 years, which the market certainly appreciated that the Fed is still pricing in at least one 25 basis point rate cut this year. So no major surprises there, and that was a positive. Moving past the Federal Reserve meeting, we did also get the Producer Price Index, otherwise known as wholesale prices, for the month of February last week. It showed that prices came in hotter than expected in the month. You can see headline prices up 3.4%, core prices up 3.5% from a year ago, rising 0.7% in the month in that headline number and 0.5% on the core number there. Now, breaking it down by category, you can see the majority of the unexpected inflationary pressures came from goods prices, with foods prices up 2.4% in a month, energy prices up 2.3% in a month, and then services also leading to higher inflationary pressures there, up 0.5% in the month of February, overall contributing to this hotter than expected inflationary picture for February's PPI. Following last week's Fed meeting and the hotter than expected wholesale inflation reading, markets have become a lot more cautious around future interest rate cuts. The odds of a rate cut this year, according to futures markets on Friday, fell to roughly 9%, compared to odds of about 94% just 1 month ago. Now, markets are actually pricing in a pretty sizable chance that we get an interest rate hike before the end of the year. However, the base case remains actually zero interest rate cuts or hikes by year end. However, this data was taken before the developments with Iran and the positive talks with Iran over the weekend, so I'm sure this data has shifted as of Monday morning. Last but not least, in terms of more regular economic data, we did get the Conference Board's leading economic index for the month of January. It fell slightly with consumer expectations, building permits, and manufacturers' new orders falling slightly in the month, while the leading credit index, stock prices, interest rate spreads, aka the yield curve there, and average weekly manufacturing hours being positive contributors during the month. While the headline index edged lower, the slower rate of decline has been an encouraging trend in recent months, with the LEI no longer signaling a recession. So that concludes this week's market update. It was a very eventful week with the Fed meeting, a lot of geopolitics, and some economic data. We really appreciate you tuning in, and we look forward to seeing you again next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.